The stock market is officially closed for the regular trading session on Thursday, July 23, 2026. Keel Infrastructure Corp., trading under the ticker symbol KEEL on the NASDAQ exchange, ended the latest session at $4.69 per share, marking a flat to slightly elevated performance following an after-hours push toward the $5 level. While retail sentiment across online investment communities often portrays this ticker as a high-powered tech breakout play ready to skyrocket on the back of artificial intelligence infrastructure demands, a serious look at the underlying financial reality tells a vastly more complex story. Most investors jumping in through their Robinhood stock trading app or tracking daily updates via their Fidelity trading platform see a company pivoting away from legacy crypto mining straight into the lucrative world of high-performance computing data centers. They look at Wall Street analyst buy ratings from firms like BTIG, which recently initiated coverage with an ambitious $8 price target, and assume this is an easy, fast-track opportunity for self-investing growth. However, the market expectation of a seamless transition into a prized data center landlord completely ignores the massive capital burn, structural execution delays, and persistent income losses currently sitting on the books. When you look at the surface narrative on popular investing sites, the excitement around Keel Infrastructure stock feels almost undeniable. Retail traders browsing through SoFi Active Investing or evaluating broad sector exposure through Fidelity ETFs see the headlines highlighting an impressive 2.2 gigawatt development pipeline spanning Quebec, Pennsylvania, and Washington. They see news of municipal approvals, such as the consolidation of 96 megawatts of power in Sherbrooke, Quebec, and assume that massive revenue acceleration is right around the corner. This expectation is built on the massive structural demand for raw power in North America, where tech hyperscalers are desperately searching for grid-connected real estate to train next-generation machine learning models. Investors using Interactive Brokers stock trading or Robinhood investments often look at this supply shortage and assume that any company holding power capacity is an automatic winner. They view Keel as a newly minted infrastructure play primed to capture premium co-location contracts with multi-billion-dollar enterprise clients. The reality hidden beneath these lofty projections presents a sharp contrast that every thoughtful individual holding an individual brokerage account needs to examine carefully. The company, formerly known as Bitfarms before rebranding to Keel Infrastructure earlier this year to signal its strategic repositioning, is carrying a heavy financial legacy from its past operations. In its most recently reported financial quarters, Keel generated approximately $37 million in quarterly revenue while posting a massive net loss of roughly $145 million. Negative gross margins, escalating selling and general administrative expenses, and high interest costs continue to drain balance sheet resources at a rapid rate. While the company holds around $350 million in cash and liquid assets, it simultaneously carries roughly $573 million in total long-term debt, much of it raised through dilutive convertible note offerings that weigh directly on existing shareholder equity. Trading momentum over recent weeks highlights this ongoing tug-of-war between speculative enthusiasm and fundamental gravity. After rallying strongly toward the $7 mark in late June on rumors of potential hyperscaler partnerships, Keel stock suffered a steep slide back down into the $4 range as reality set in regarding execution timelines. For instance, while municipal consolidation approvals in Sherbrooke sound promising on paper, the underlying land purchase required to construct the full high-performance computing campus is not expected to close until early 2027 and still requires critical provincial regulatory sign-offs from Quebec's Energy Ministry. Traders utilizing SoFi Invest or checking their Fidelity mobile app saw firsthand how quickly optimistic price targets can collide with real-world infrastructure delays, as the stock gave up weeks of gains in a matter of trading sessions. Comment below how many shares of Keel Infrastructure stock you currently hold, or if you think legacy crypto miners can successfully transform into high-performance computing data center operators. To understand why this gap between expectation and reality exists, it helps to look closely at institutional activity and trading volume behavior across the major exchanges. Institutional investors managing accounts across Schwab Intelligent Portfolios or executing complex strategies through interactive brokers' fee structures have shown a divided approach toward Keel stock. On one side, small-cap index funds like the iShares Russell 2000 ETF and Vanguard Expanded Market ETF hold meaningful passive positions driven by the company's market capitalization bouncing around the $2 to $3 billion mark. Active tech managers and specialized funds, including the Fidelity Crypto Industry and Digital Payments ETF, maintain exposure because of the sheer scale of Keel's energy footprint. Yet short interest and daily trading volatility remain exceptionally elevated, with the stock exhibiting a beta coefficient well above 4, making intraday swings particularly intense for retail market participants managing self-investing accounts. Understanding the underlying business model explains why this volatility exists in the first place. Keel Infrastructure Corp. Originally built its footprint by acquiring land, securing utility interconnections, and constructing high-voltage electrical substations specifically designed to power vast arrays of application-specific integrated circuit computers used for validation on the Bitcoin blockchain. Operating out of sites like Panther Creek and Scrubgrass in Pennsylvania, alongside facilities in Washington State and Quebec, Canada, the company's primary business was selling hash-rate computational power and mining digital assets. In addition, the firm historically provided commercial electrician services and hosted third-party hardware to diversify cash flow. However, after the post-halving economics of cryptocurrency mining, where profit margins compressed across the entire industry, management recognized that its most valuable asset was not the mining rigs themselves, but the raw secured electrical power capacity connected to the grid. High-performance computing clusters and artificial intelligence workloads require unprecedented amounts of continuous baseload electricity, creating a severe bottleneck across North American power grids. By attempting to reconfigure its existing campuses from crypto mining warehouses into institutional-grade co-location data center facilities, Keel aims to pivot toward signing long-term, predictable multi-year lease contracts with enterprise cloud providers, neo-cloud developers, and artificial intelligence startups. Yet converting a legacy Bitcoin mining shed into a modern Tier 3 or Tier 4 high-performance computing data center is neither fast nor cheap. High-density artificial intelligence chips require specialized liquid cooling infrastructure, redundant backup generators, high-bandwidth fiber optic connectivity, and massive upfront capital expenditures that far exceed basic mining setups. This is precisely where the core tension lies for investors reviewing investment help resources across Fidelity mutual funds, Robinhood stock trading, or SoFi robo-advisor portfolios. The market is currently pricing Keel as if it has already secured lucrative cash-flowing co-location leases with top-tier technology giants. In truth, as Wall Street coverage explicitly notes, securing its very first major high-performance computing co-location deal remains an unfulfilled immediate focus rather than a completed milestone. Looking ahead, the future outlook for Keel Infrastructure stock rests entirely on management's ability to execute this transformation before its cash reserves run thin or debt burdens force further equity dilution. There are two distinct paths the stock could take over the coming quarters. In a bullish scenario, if Keel successfully leverages its energized capacity and pipelines in Pennsylvania and Quebec to finalize a binding contract with a major cloud or intelligence customer, the stock could rapidly re-rate upward toward analysts' optimistic $8 to $10 price targets. Such a deal would substantiate the transition, providing long-term contracted cash flow that offsets ongoing operational losses and reduces reliance on debt financing. Investors who bought into the narrative via Robinhood cash management or Fidelity brokerage accounts would see their patience rewarded as real enterprise revenue replaces speculative momentum. Conversely, the bearish risk scenario is equally substantial and cannot be ignored by anyone engaging in intelligent portfolio management. If regulatory delays in Quebec drag on beyond expectations, or if capital expenditure requirements force management to issue additional convertible debt or secondary equity offerings at lower valuations, current shareholders face significant dilution. Furthermore, if larger traditional data center operators with deeper balance sheets manage to capture regional market share faster, Keel's legacy power assets could struggle to command premium lease rates. In that situation, the stock could easily retest lower support levels near the $3 threshold, forcing online investing communities to reevaluate the true